Welcome to the sixth edition of our podcast series, Talking Data, that offers timely insights into macro data and its impact on the economy and markets. I'm Kristen Radish of Arbor Research and Trading. I will be today's moderator. Our podcast features Jim Bianco of Bianco Research. In today's installment, Jim will be discussing the state of the economy. Jim, let's get started by talking about the rise of alternative data. What kind of data do we use?
The thing is that with the pandemic, as we all know, the economy has been moving at lightning speed. The second quarter GDP was minus 32% annualized, but minus 8 actual, a mind-boggling number. Third quarter GDP, which third quarter ends next week, is supposed to be plus 25%, another record in American history on the other side. So with this kind of speed, we're looking for high frequency data that comes out daily or weekly and doesn't get revised a lot to try and get a sense of where the economy is going. Most of the data falls into a couple of different camps. One of them is, the big one is mobility data. We look at how mobile people are by tracking cell phones to see how much they move around as well. We also look at other high frequency data like restaurants, Homebase, which is a service that small businesses use to track hours and customer billings. They put out daily indexes as well too. We look at airline traffic through the TSA, how many people went through TSA at the airport, or we look at transit data, how many people are riding on the subways and the buses. So that's the extent of the data. We're looking at that data because if we go to the traditional data, let's wait and see what the payroll report says, and then it gets revised for the next 2 months. We've already missed down 30%, up 25%. So we've got to look for stuff a little bit faster. In addition to this data, there's some more traditional high frequency data we can look at. The first one that comes to mind is initial claims as well too. And the other one that comes to mind is Citibank has a bunch of good economic data change indices. They're part of the surprise index. Everybody knows about the surprise index. It's made up of the data change index, which is what the economy is doing, minus the consensus, which is what the economists think gives you surprise. We've found if we look at the data change part, it's a lot more telling, and that's a daily statistic too. So that's kind of the broad overview of the type of data we're looking at.
And what is all that data as you measure it? What is it really telling us then?
Well, history shows, no surprise, is that we had a big down into March or April. It's most likely that when all is said and done for the moment, that the recession started February 29th. That's already been called by the National Bureau of Economic Research, NBR, who calls recessions. Probably ended in April or May, the recession, but it was one of the deepest that we've seen, certainly in our lifetime, if not American history. Then the recovery began. But somewhere between late July and mid-July and late August, that recovery stalled. And it is stalled at levels meaningfully below the pre-COVID levels. So we've gotten back 70 or 80% of what we lost during the COVID shutdowns, but not 100%. And we've stalled. To get back the rest is, at least at this point, seems like it's going to take a long time because we're not really doing anything. The good news is we're not pulling back, at least in any meaningful way. We're not going in reverse, at least not yet. But we are not definitely moving forward. There is one other data point that I'll throw out here as well too. So Bloomberg does a daily survey of a panel of about 70 economists on their forecast for GDP. Now, not every economist changes his forecast every day, but they check in with them every day to see who's changing and when. So in early June, they thought the fourth quarter GDP would be 11%. That's a huge number. That is a mind-boggling fast number. Today, it's at the lowest level since June, actually the lowest level since March, at 5%. Now, 5% is a strong number, but it's gone from 11 to 5 pretty much straight down, and we still haven't started the fourth quarter. Then you throw in that there's increased viruses coming out of Europe, not the United States, but Europe, with the fear that maybe it catches on here and we see a bump up in viruses. necessitating some kind of a rollback in the reopening, and the lack of fiscal stimulus. And you've got a lot of economists that are actually pushing down near zero for fourth quarter GDP if the virus count continues and lack of stimulus. So we're really, that underscores, zero doesn't mean we're going backwards, but it underscores this idea that we're really starting to stall quite a bit.
So you touched on one of the big concerns that's been in the news quite a bit today, the rising infection counts in Europe. You know, could you just dive a little bit deeper into that and how it might impact the US?
Yeah, so a quick word about infection counts. Whenever I tweet these out, I tweet them out and then people go crazy. What about the death count? What about ICU usage? What about the demographic ages of everybody who's getting sick? Well, you know, all of those are valid statistics. But if my concern is shut down, reopen, what is the policy that's going to come from it? It's driven by the virus count. It's driven by the number of sick people announced every day. You know, no one's going to say, oh yeah, we're booming with sick people, but guess what? No one's going to the hospital, so doesn't matter. Take your mask off, go to work. No, it's not going to work that way. If the case counts are going up, we're going to see rollbacks like we saw today. We're speaking on Tuesday, the 22nd, and today the UK rolled back some of their reopenings and put restrictions on it. Over the weekend, Israel, which has had like a tenfold increase in their cases, did something similar as well too. So with that as a backdrop, we have seen the case counts peak in April in Europe, fall off to late June, early July, and then kind of meander sideways. And now they're climbing back up to near their April peaks. Some countries like Spain are beyond their April peak, meaning the worst case count that they've had so far is now. Countries like France are equal to April. Countries like the UK are not quite at April, but all of them are in steep increases. Fear is, of course, the US peaked in June, Europe peaked in April. Europe seems to lead the US. You know, where Europe is where the US will be in about 6 weeks. That is, I think, part of the fear that we're seeing in the markets is that, oh man, Europe is telling us that by the end of October, right in time for the election, we're going to be booming again in the case counts as well, if that pattern holds. We'll just have to see whether or not it does. There has been a small uptick in the US cases recently, but not a big one. Last thought for you on this, a lot of people say, oh yeah, the case counts because of increased testing. Everybody's come out and looked at it and said it's not about increased testing. It's about there is a resurgence of the virus. Now, the good news is it's not as deadly. Not many people are getting hospitalized. But like I said, it's the case count that drives the policy. It is not the death count that drives the policy. No politician is going to come out there and say, hey, we've got more cases now than we've ever had throughout the whole pandemic, but nobody's going to the hospital, so ignore it. That's just not the way it's going to work. They're going to react to the case count, and that's what they're doing in Europe. And the fear is it might be coming here. And with the slowdown in the economy, you know, the stalling of the recovery and the case count, I think it's not surprising that we're seeing markets have their biggest correction since the March low.
I was going to say, let's talk about overvalued or the manic markets next.
Yeah, so going into early September, the markets were on fire. Davey Day Trader, Dave Portnoy, was tweeting out 7 times a day. Stocks only go up, and when in doubt, remember, don't forget rule number 1. And then the market starts collapsing, and I've been following his Twitter feed. I think he's gone now 3 or 4 days with a tweet on the stock market. Oh, he's all into now betting on the NFL and betting on college football. That's his primary thing, but he seems to be very quiet about the stock market, or the joke is he's now become a long-term investor instead of a trader because the market's moving against him. But in that respect, I do think that when you look at the markets, they were at a manic phase by early September at the high. The options trade data was booming and everything else. Now, what's interesting is through last Friday's data, because we get good detail on the weekly data from the Options Clearing Corp, that mania really hasn't reversed. It's off its froth. It's not as high as it was 3 weeks ago, but take out the last month and the amount of option buying by retail investors, the amount of new long positions, betting on stocks going up, the highest they've ever been other than the last month. So it is not really, we've not broken the back of the mania just yet. They're still out there, still trying to bet that this is a buying opportunity, and that's very worrisome. Add to that this big rally in the market and the inability of the economy to respond in kind. If the economy is 80% of the way back, the stock market's way more than 100% of the way back. It's gone beyond the old highs. It's at overvalued levels, and it's vulnerable. It's vulnerable to a rising case count, political instability, and this mania market that might still break and cause a rush of selling as all of these traders get out of the market. So it is vulnerable right now, and I still think it will continue to work its way towards a 10 to 15% correction. We've done 8.5 on the S&P as of yesterday, so we're almost into that range. We're 12 on the NASDAQ, 12% correction on the NASDAQ, so we are in that range. But why don't I think it's going to be more? I just said mania and I just said overvalued because we've still got the Federal Reserve. It's going to play the final act. And the phrase I've been saying is they'll throw a kitchen sink or 2 or 3 at this market to try and stop it when they get sufficiently worried. 8%, they're not sufficiently worried. But if we get 12, 15, 18%, I think you see them act. And I think a lot of people are betting the Fed's got their back. And that's one of the reasons why they're steadfastly just keep those long positions, even though they're losing money, because they will come back.
And the next thing coming up, of course, is the election and all the uncertainty. Can you touch on that?
Yeah, this election is like no other election that we've ever seen. And I've been fond, if you've been listening to these podcasts, that the election will turn on events that have not happened yet. And then we had the Kenosha unrest. And then we had Ruth Bader Ginsburg pass away this past weekend as well, too. The thing about that is it changes the conversation. We're not talking about Boris Trump behavior or tweets or whether or not Biden can complete a sentence anymore. That the whole conversation has been changed on that. Unclear as to who it benefits, at least for the moment. We'll see how this progresses. This election is going to be another big uncertainty event. Now, there's 2 things I've been focused on with the election. Well, 3. One is we're going to get more of these things out of the blue, like RBG passing away, that we didn't anticipate. Second is a week from tonight is the first debate. And I've argued it's the most important debate in American history. That's a little bit of hyperbole, but what I mean by that is the debate's all about one thing. Can Joe Biden finish sentences? Can Joe Biden not lose his train of thought? He comes out, I'm trying to be, nonpartisan here. He comes out, he's witty and he's with it, and he can speak and bring up good points and go back and forth with Trump. He wins. He wins because all that talk about Joe's lost his fastball and he's slowing down, all of it's proven wrong. He comes out and he starts mumbling and he forgets what he was talking about in the middle of a sentence, and it makes no sense. Friday, he was asked a question about climate change and he talked 7 minutes about pig feces in Delaware. What, Joe? What are you talking about? He does that. People are going to shake their head and go, man, this guy's just not ready for the job. So it's entirely within his capabilities, if he's still got it, to prove us all wrong and Joe become a big winner. Trump, people say, what about Trump? What about Trump's competence? Trump, we know what he is. You might like him, you might detest him, you might find him disgusting, you might find him the best president ever. But your opinion's set on Trump. In fact, most people say that about 98% of the American public already knows who they're going to vote for, but only about 60% of the American public actually votes. So this is not an election about convincing people to vote for me. This is about an election about convincing people to go to the poll and actually pull the trigger, is really what this is. So this is why I think you see a lot of this extreme behavior from both sides. It's not about trying to convince the other people that are undecided. There are no undecideds. Or the other party, hey, take a chance on me. That's not going to happen. It's convincing my voters. Now you love me, you actually have to vote for me. You just can't say you like me and not do anything about it. That's going to create uncertainty. And the last thing about that election, like I said, unforeseen events, how Biden does. And the third thing is I didn't coin this phrase, but it's called the red mirage. Most of the people that go to polls are going to lean Republican most of the people that send in mail-in ballots are going to lean Democrat. Everybody who analyzes this says this. I'm going to take their word for it. There's a theory out there that election night, 2 o'clock in the morning, Trump comes out. He's won all these states. He's got 270 electoral college votes by the polls and the counting of the votes. Declares victory. Then the mail-in ballots come. And a couple days later, one of these states flips because the mail-in ballots skew Democrat, and it goes the other way, and another one and another one. So Trump wins, and then he kind of just watch it just kind of bleed away by Thanksgiving. That could be very, very damaging for the country. It could really shake confidence in the country as well, too. And it could create a tremendous amount of uncertainty if that is the way that this thing plays itself out. So it's another reason why I think these markets are going to be struggling as we move forward from here.
Any parting thoughts today to sum up our state of the economy?
Yeah, I really think that when it comes to the economy, I tend to lean libertarian Austrian. If you tell me, does the economy need stimulus from the government? And the answer is no, usually by rote. This time I'm going to change my tune and I'm going to say yes. And I'm going to say yes for the following reason. The reason the economy is struggling is we had a forced shutdown by the government on the economy. Good reasons. I'm not saying that they were wrong to do it, but the government did shut down the economy and it impaired people. And even though we've gotten a lot of jobs back, 9 million people are still unemployed that were employed in March. So just like if the government wants to take my home to build a highway through my land, they have eminent domain. They have the right to do that, but they have to compensate me for it. They just can't take it and build a highway. Well, you shut down the government. You did it for a legitimate reason, but you need to compensate everybody for taking legitimate businesses and telling them, no, you can't do that anymore. And that's where the fiscal stimulus comes in. And I do think it makes a little bit more sense in this instance. And I'm with the idea that if we don't get it, maybe we get it post-election in the lame duck session, but if we don't get it, it will be a big drag on the economy, further impairing the ability of the markets to rebound and the ability of the economy to move forward.
Thank you, Jim, for your thoughts today. Appreciate it. And thank you, everyone, for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm that produces innovative research across a broad range of global fixed income, equity, currency, and commodity markets. Bianco Research and Arbor Data Science are our two most prominent research offerings. For further information on Arbor Research, Bianco Research, or Arbor Data Science, please contact Gus Handler.